Good afternoon, everyone. It's Thursday, May 7th. I'm Kent Kramer, the Chief Investment Officer at Foster Group, and this is our special weekly market update. As you know, we've been putting this weekly video together since the pandemic started as a way to serve our investor clients and people who come to Foster Group for advice and counsel. Times like these are hard for investors to go the course alone, and we just want people to know that we're here to help. We have over 1,400 clients today who we truly care for. It's our pleasure to help with all aspects of their financial planning, especially in preparation for uncertain times like these. We're also doing this to provide helpful perspectives during the crisis, and we're very excited to bring a unique webinar opportunity to people next Thursday, May 14th. Jan Selzer has been a political pollster for more than 3 decades. She's president of Selzer and Company here in Des Moines. Her company and her polls, they have a track record for accuracy in election polling that's been consistently rated an A+ from Nate Silver's influential website 538. And we're very fortunate to know Ann and to have the opportunity to bring her insights to you next week. And so we have some registration information on the screen here for you. We're calling this financial resiliency in a world of political uncertainty, because especially today, the world obviously seems very uncertain, both the political environment, the financial environment, personal health. All these things go together in how we make good decisions. And we're looking forward to a great presentation from Ann and a great conversation with her afterwards. Participants will have the opportunity to text questions to Ann as well to get her insight on all things political in terms of what's happening around the United States today. So please join us next week if you can. Let's look a little bit here at the week that's gone by. We're going to stop here on Thursday just due to a scheduling issue. But this has been largely a week of relative calm, which is kind of a nice thing to say, actually. COVID-19 cases are flattening a little bit, and they're falling in most places globally. You can see from this chart, the top line, the greenish line, is actually trending down a little bit. That represents daily confirmed new cases, 5-day moving average in the United States. So one of the big winners in the health crisis here has to be Johns Hopkins Medical University. Their website is cited by news organizations all around the world, and they provide such helpful data and visualizations. I look at their website virtually every couple times during the week. Just a great provider of information. Other things going on this week, more employment information. U.S. non-farm private sector lost 20.2 million jobs in April. More than 30 million jobs have been lost since the end of February. The U.S. labor force reached a peak of 164 million people prior to the COVID-19 impacts. Another piece of good news this week, the first human vaccine trials began. Some brave people who have not been diagnosed with COVID-19 have been given vaccine trials to see if this is going to be an effective vaccine that could be mass produced later in the year. The U.S. Treasury also announced a record $96 billion of new bonds being issued on May 20th. They're reintroducing the 20-year Treasury bond that hasn't been available since 1986. They're planning on issuing some longer-term debt because of low interest rate environments, chance for the federal government to save on interest costs for a while. And of course, last weekend was the Berkshire Hathaway annual meeting. It was very different from previous meetings. There wasn't a big carnival atmosphere because people couldn't gather together, but there were still comments by Warren Buffett. And one of the things he said I thought was very encouraging when someone was asking him about what he thought about investment opportunities around the world. He said, in the end, the answer is never bet against America. He talked about the history of investors, history of investment in companies inside the United States, and the incredible record of the public market in the United States to generate wealth for individuals. We can see some of the market results for the week here. Again, what we look at in this chart is the S&P 500, the aggregate bond market, stocks outside the US. And this week also I put in, you can see there the QQQ, which is an ETF that tracks the NASDAQ market. The NASDAQ has gotten a lot of attention recently because its returns have been significantly higher than other parts of the market. You can see that was also true this week. And I thought it'd be helpful to look at maybe what's going on behind the NASDAQ and what's helpful to know as we think about the companies that are inside of it. According to data from Goldman Sachs, the top 10 stocks in the S&P 500 this month accounted for roughly 27% of the total value of the index. Think about that, that's amazing. They haven't had that kind of concentration since the late 1990s. course, the companies that make up that index are the ones we're all familiar with. You can see the tickers out there to the far right, representing Amazon, Apple, and Microsoft. And what you're looking at on this chart is their holdings weight in that QQQ, or the NASDAQ market. And what they're showing here is that Amazon alone represents 10% of the NASDAQ market capitalization. Apple represents close to 11, Microsoft just over 12. So those three companies represent an incredible exposure in terms of their part of that NASDAQ market. The top five companies in the NASDAQ market, the five biggest companies actually in the United States stock market as a whole, you can see they've had some really, really good investment performance over the last 3 years and even year to date. Starting with Microsoft, who in this year, when things have been so difficult for so many, their stock is actually up over 16% year to date, a 3-year annualized return of 40.7%. If you look down below, you'll see various stock market indices, and these are indexes that are made up of hundreds of stocks. The Russell 3000 is the 3,000 largest stocks traded in the United States, the S&P 500, those 500 large companies. Then there's the NASDAQ market, then there's the MSCI All Country World. Those are companies outside the United States. And you can see that their returns as a whole are lower than that NASDAQ market. So some people say, well, why wouldn't I just invest in the NASDAQ? And this chart talks about the concentration of return in the NASDAQ. Again, I'm looking at those 5 largest companies in the United States. And the thing that I really want you to notice is when you go about halfway down the list, you'll see the leaders. I'm calling these 5 companies the leaders. Their combined cap weight of the index, in other words, the percentage of the index that their company value occupies. In the S&P 500, those 5 companies represent 20% of the index value. In the NASDAQ composite, those 5 companies represent 45.7% of the index's value. You think about that, that's amazing. Over half, almost half the index's value is represented by 5 companies. So when you think about the outperformance of the NASDAQ market, really that NASDAQ market performance is driven by the performance of those 5 companies. It's quite a concentration. The other thing I draw your attention to in this chart is if you look at their combined contribution to the index return. So in other words, if you take their weighted average, the proportion of the index that these 5 companies represent, and the returns that they've had so far year to date, you can see their contribution to the index. So look at the S&P 500. The leader's contribution to the S&P 500 index return is a positive 2.2% for the year. Now the index year-to-date return is a negative 11.7, which means if you think about all the other companies inside the S&P 500, their contribution to the return of the S&P 500 is a negative 13.9%. So if you look at the kind of the bulk of the other companies in those 500, in that 500 companies in the index, what you see is they've not had a very good year. But those big 5, the leaders, they've done relatively well for the year. When you kind of extrapolate that and you look at the NASDAQ, you can see even a bigger effect, right? Because those big 5 represent 45% of the index. Their combined contribution to the NASDAQ's return is 5.1%. People have been looking at the NASDAQ going, well, hey, it's positive for the year to date. That must be the place to be. Well, again, if you look at the return of the NASDAQ participants, X the leaders, so if you take out those big 5, the NASDAQ as a market is down 2.1% when you calculate the return of all the other companies that are listed on the NASDAQ with the exception of those top 5. The reason I think this is important is because if we just go back about 20 years to the end of the late 1990s, what happened to the NASDAQ, the last time it had this kind of concentration in a few very recognizable names, there was a high-tech index at the time. It still is a representative index of a lot of technology and communication companies. What you see is the NASDAQ peaked in 2000, kind of late 2000, and then it began to go down when the tech bubble burst. And you can see that it went down and it stayed down and stayed in negative territory for the better part of 14 years. It started to decline in March of 2000, and it didn't fully recover until November of 2014. So for 14 years, it had a 0% annualized return, a 0 aggregate return. Quite a bit different than what we've seen in the last 3 years. Since 2009, since the great financial crisis, the recovery in the bull market has been a decade of dramatic outperformance for NASDAQ stocks. Really, the question is, what does the next 10 years look like? The reason I'm pointing this out, I think kind of people have had a lot of attention focused on the NASDAQ and particularly those big five stocks. What you can see is both the positive and the negative of concentration. The early 2000s were the negative of concentration. If you had a few big companies doing very badly, they could drag the whole index down with them. If you have a few big companies who are doing fantastic, like they have been lately, and from the great financial crisis forward, and particularly here in the last, let's say, 6 to 18 months, the performance of that NASDAQ market has been great, better than other markets around it. The red line on this chart is the S&P 500. The point here is for an investor who is diversified amongst 500 US stocks versus kind of relying on the big five, they had a little bit better return over the course of that 20-year period. And a lot of people would say, well, it's just because they're more diversified exposure to a variety of industries. So when the NASDAQ went down because technology had such a hard time, the S&P 500, while it went down some, it didn't go down nearly as much. Quote for the week, those who have knowledge don't predict. Those who predict don't have knowledge. I like this quote because I thought it related well to the presentation coming up by Ann Selzer in terms of political polling. Sometimes we like to make predictions about the future when it comes to politics. Also has something to say about the way we think about markets. A lot of people like to make predictions about which way the market is going to go next and how much. This quote says, better to be humble about having predictions to make. It's fine to have expectations over long periods of time, but oftentimes our forecasts turn out to be not worth very much. Again, thanks for attending this week. If you have any comments or questions you'd like us to address at Foster Group, you can reach us at these email addresses. Also, just kind of, again, encourage you to respond to attend next week's event with Ann Selzer. We think it'll be a really interesting conversation, and we hope you can make it. Talk to you soon.